Welcome to Tax Talk Tuesdays. I am Anna Klein, your virtual CPA and tax strategist, aka literally the person who likes to read the tax code so that you don't have to. Every Tuesday, I am going to be answering your burning questions. Yes, even the weird ones that you've been too afraid to ask your current accountant, whether it's about write-offs, LLCs, or why your cousin down the road is literally writing off the weirdest things as a barbershop, okay? I got you. If you want your questions featured and answered, what you can do is hit the link below, submit your question, or you can definitely slide into my DMs with your question. If you've been following me for a long time, my motto is as follows: play the game just like the wealthy people do. So let's start with question number one. Someone left a comment on a video about writing off your entire G Wagon. They said, what if you lease a car? When you lease a car, you are not allowed to take that huge bonus depreciation. You're actually only allowed to take either the lease payment, a percentage of the lease payment, and then any other expenses related to the car. In order to actually write off the full G Wagon, car over 6,000 pounds, you actually need to buy the car. So a lease will not allow you to take depreciation. If you want more information on the differences between buying or leasing and what qualifies as 6,000 pounds, I've linked the video below that talks about what exactly you need to write off your G Wagon. Question number two came from this video that got so many hate comments, literally telling me I'm going to go to jail, that I am doing things illegally. But if you don't know what the short-term rental loophole is, I've linked also the video below for you. This can literally wipe out all of your taxes. So this person asked, if you want to use the short-term rental loophole, do you have to manage it yourself, or can you have a property manager company manage it for you? So here's the thing with the short-term rental loophole. You have to meet two requirements. Number one, you have to have on average 2 stays that are 7 days or less. And the second requirement is that you materially participate in your rentals. There are 7 tests that you can pick from. However, here's the big one. If you only have one short-term rental and it's your first year and you hire a property manager, you're going to have to prove that you worked on this property 100 hours or more than each person that has worked on the property. In other words, let's say that you buy this property, I don't know, January 1st, right? And by January 31st, you have it live, it's ready to go. And you're like, here you go, property management company. You're literally not doing anything. You're sitting back and being passive. So having a property manager for just one short-term rental is most likely not going to allow you to qualify for the short-term rental loophole that I was mentioning. Now, as you grow your portfolio, we can group them from a tax perspective, and it's a lot different, but just one might not qualify for that. Question number 3 also came from this video about the short-term rental loophole that got so much hate and so many negative comments. And this person asks, and what happens when you sell the property later for a profit? You'll have to pay back all the depreciation that you claimed. And that is true. When you take bonus depreciation and you decide to sell the property, you will have what we call depreciation recapture. Now, there's strategies to minimize that. So let's say, for example, year 1, you purchase your short-term rental, you wipe out all of your taxable income with the cost segregation. And 4 years later, you're sick of it and you want to, or maybe you just want to upgrade your portfolio. What you can do is do a 1031 exchange. Or in that case, if the 1031 exchange doesn't work, try to find a property of greater value, do a cost segregation, and try to minimize your taxes as much as possible from the sale of the old property. Here's a tip though, do not ever buy a short-term rental just for the tax benefits. A lot of people did this in 2020 and they took the bonus depreciation. In 2021, they realized it was so much work and they ended up selling it and paying back the taxes. Tax strategies are for the long term as well, not just for today. This question is in regards to paying your children. If you have children and you have not paid them through the business, you can take up to a $15,000 write-off per kid per year without paying any taxes on it and without your child filing a tax return as long as they're under the age of 17. So this person asked, how old do your kids have to be? Now, I created a YouTube video talking about how to literally do this, so I'll link it below. But this is a great question that I get a lot. How old do my kids have to be? It has to be reasonable, right? Realtors, I'm going to call you out on this. My realtor clients love to say, well, my 3-year-old, I'm going to put him on the front page of our magazine or our ad, and they're going to sell the house. And I'm like, No one cares about your kid. I am so sorry, but no one's buying this $1 million home because your child's face is on your business card. So it has to be legitimate. I have some clients that do YouTube and their children are part of YouTube and they generate money through having their kids on YouTube. There's no age limit on that as long as you can prove that the child is generating revenue for the business, right? Now, if your child is usually around the age of 11 and you're flipping properties, they can help you out. So you have to make sure that you have really good records. But don't try to say that your 1-year-old is helping you, be the face of your company because, sorry, nobody cares. This question is also in regards to paying your children. And they ask, do you need to pay them a W-2 or a 1099? Do you need to set up an LLC or an S Corp, or can you be a sole proprietor? Paying your kids is a very heavy compliance tax advantage at the beginning. And there are 2 ways to do so. So I literally linked this video below for you guys because I walk you through step by step. If your child is under 17, how do you pay them? If you have an S Corp, how do you pay them? If you have an LLC just with rentals, how do you do this? It is so much easier me walking you through it than literally just talking about it. So click the link below, go watch the YouTube video, walks you literally step by step on how to do it. Should you roll your old 401k from your old employer to your new employer? The answer is no. Listen to this. This is the number one secret that wealthy people don't want you to know, but I'm going to tell you. It's called self-directing your IRA. And if you have no idea what that is, I'll link the video below that talks about how this guy is about to pay $0 on a $5 billion IRA. So one way to get money into a self-directed Roth IRA is by doing a backdoor Roth conversion. So this person is asking, can multiple employers' old 401k be rolled into one self-directed IRA? And the answer is yes. Let's say, for example, in your last, 10 years, you've had multiple jobs that have little 401ks and you've left them parked there. And now you learned about self-directing your IRA. So what you should do is you should take all of those old ones and roll them over into a self-directed Roth IRA. That is what we call backdoor Roth IRA conversion. You will have to pay some taxes and there might be some tax implications besides that, but you can take all of your old 401ks as long as you do not work there anymore and roll them over to a self-directed IRA. If you want to pay 0 taxes when you're older in your real estate, this is how you do it. It's called self-directing your IRA. Now, this person had a question. How do I use my self-directed IRA for real estate? What Schwab and Fidelity don't want to tell you is that you can actually purchase different assets in your directed IRA. Now, what can you do in your self-directed IRA? Here's a couple of things that you can do. You can lend money. You can become a private lender to flippers out of your self-directed Roth IRA. Whatever interest you make on that, you're not going to have to pay taxes on that. What if your friend comes along and they say, "Hey, I want you to become a partner in my flip. You put in $100K, I put in $100K, we're going to make $400,000. Whatever money you make from that flip, as long as you've used your self-directed IRA as a partner, will go back into that self-directed IRA and you will end up paying 0 taxes on that as it grows. Self-directing your IRA is a huge strategy that wealthy people use for the future that allows you to pay 0 taxes on that. Can you move your money from your current employer to a self-directed IRA? The answer is no. Usually the plan with whomever you're working, your employer, let's say Chase Bank, is not going to allow you to take all that money from their 401k and roll it over to a self-directed IRA. What you want to do is you want to make sure that when you leave that employer, you don't roll it over to your new employer. Instead, you're going to do a self-directed IRA rollover, which then it will allow you to do that when you leave that employer. That's a wrap for this episode of Tax Talk Tuesdays. Remember, we help business owners and real estate investors play the IRS game just like wealthy people do every single day. So if you're ready to stop overpaying in taxes and learn how to actually play the game, book a free call with our team and we'll be able to help you out. So until next time.